The United States stock market is closed today, Sunday, May 31st, 2026 at 7:24 p.m. Eastern Time. Looking at the final numbers from the most recent live trading session on Friday, May 29th, 2026, NOKIA stock closed at $14.84 per share, reflecting a daily decline of 3.1% on a massive trading volume of over 113 million shares. This late-week drop might seem like bad news to the untrained eye, but the real narrative here is completely different. Right now, this legacy corporate name is experiencing an aggressive institutional reassessment that has pushed its valuation up by more than 140% since the beginning of the year, making it one of the absolute best-performing assets in the global tech space. While retail traders might be looking at the single-day pullback as a sign of weakness, the smart investment capital is realizing that the big picture story here is no longer about cell phones or standard telecom infrastructure. It is about a massive structural pivot into hardware engineering that could change how tech networks interact with cloud intelligence. The general expectation for this asset has always been incredibly sluggish. For the better part of a decade, the broad narrative across retail investing sites and online investing platforms was that NOKIA stock was a dead asset, a relic of early mobile tech that had failed to compete with modern tech monoliths like Apple stock. Most people viewed it as a low-margin telecom supplier trapped in a slow-moving cyclical market. However, the reality of the situation completely shatters that view. Major Wall Street institutions and multi-billion-dollar algorithmic systems are aggressively treating this company because it has suddenly repositioned itself as a cornerstone of the modern data center boom. NOKIA recently launched a dedicated innovation center focused entirely on large-scale cloud infrastructure networking, partnering directly with hardware giants like AMD and Lenovo. The massive expectation gap lies in the fact that while the public still associates this company with legacy hardware, its actual financial reports are showing a 49% surge in their specialized cloud and data center network segment. If you look at recent trading volumes and open interest across individual brokerage accounts, the shift in momentum is undeniable. Over the last month alone, the asset has experienced a massive 54% return, turning what many retail players thought was a temporary short squeeze into a prolonged macro run. The intense volume spikes we saw over the last few sessions indicate that large-scale institutional systems are rotating capital into this name, treating it less like a legacy utility and more like a high-growth hardware play. To put this into perspective, think about how modern traders use a Fidelity trading platform or an advanced Robinhood app interface to seek out hidden infrastructure assets. They look for companies providing the underlying plumbing for massive computing tasks, and that is exactly where the heavy buying pressure is coming from. When you track the daily price swings from the past week, you can clearly see the classic pattern of institutional accumulation followed by short-term retail profit-taking. On Tuesday, the stock surged over 6% following a massive partnership announcement, outperforming almost the entire technology equipment sector. That run pushed its 12-month forward price-to-earnings multiple from a modest 17 times up to a staggering 36 times. This type of dramatic valuation expansion usually only happens when the underlying market narrative undergoes a fundamental shift. For a long time, standard online investment portals and traditional investment help forums labeled this asset a value trap. Now it is being compared to specialized optical component manufacturers whose share values have multiple times over. The recent 3.1% drop on Friday is simply a natural cooling-off period where short-term momentum traders on retail apps are cashing out their gains, while long-term institutional accumulation remains highly active. Let us look at the deeper technical realities of the macro sector right now. The global tech landscape is experiencing an insatiable demand for extreme speed data transmission inside data centers. Traditional fiber networks cannot handle the intense computational workloads required by modern software applications. This has created an unprecedented demand for specialized optical networking systems, which happen to be Nokia's core technological strength. Earlier this year, NVIDIA stock made headlines when their parent firm executed a massive $1 billion strategic partnership and equity investment directly into Nokia's infrastructure architecture. This was not a minor corporate endorsement. This was a deliberate structural alignment where elite computing chips will be directly integrated with high-performance optical networks to build next-generation data hubs. Comment below how many shares of NOKIA stock you currently hold, or if you are tracking other infrastructure assets instead. This massive cash injection and engineering partnership sent a powerful signal across every major self-investing account and individual brokerage platform globally. Suddenly, the asset was no longer valued as a lagging telecom business, but as a primary beneficiary of the massive hardware infrastructure expansion. To fully understand the tension between market expectation and financial reality, we have to look directly at the latest quarterly financial statements. In its first quarter interim financial report, the company posted solid structural growth that shocked the broader consensus. Net sales climbed by 4% on a constant currency basis, but the real highlight was the explosive 49% growth in their cloud and network infrastructure division, which brought in a massive €1 billion in pure order intake during a single 3-month period. Their specialized optical network segment alone grew by 20%, driven by a book-to-bill ratio well above 1, meaning they are taking in new orders much faster than they can fulfill them. Furthermore, their gross profit margins expanded by 320 basis points to 45.5%, proving that the business is successfully moving away from low-margin legacy contracts and shifting toward high-value, high-margin proprietary tech solutions. This massive expansion in profitability is exactly what causes a stock to undergo a major long-term structural re-rating. Now, let us ground this analysis by looking at what the company actually does and how its core operational model is structured. Headquartered in Espoo, Finland, the firm operates as a global network infrastructure provider divided into several distinct business units. The largest segment by pure volume has traditionally been mobile networks, which provides the base stations, radio access technology, and core software for major global telecommunications carriers. This is the older legacy side of the business that historically kept the valuation depressed. Because global telecommunications carriers have slashed their capital spending budgets after the initial wave of global 5G rollouts, this specific division has faced significant headwinds, remaining relatively flat in recent quarters and acting as a primary drag on corporate profit margins. The second major division is network infrastructure, which encompasses IP routing, optical networks, and fixed fiber systems. This is the powerhouse driving the current market rally. By designing advanced optical transport systems that connect massive server clusters with near-zero latency, this segment is capturing the massive spending wave originating from global hyperscale data center operators. The company also manages a highly lucrative intellectual property division known as NOKIA Technologies. This segment controls an enormous portfolio of thousands of foundational patents covering mobile communications, hardware design, and video coding standards. This patent asset engine generates highly stable, near-pure margin licensing income from smartphone manufacturers, consumer electronics brands, and automotive companies worldwide. However, this division occasionally faces legal and regulatory hurdles. For instance, a recent ruling from the UK Court of Appeal placed certain limitations on how standard essential patents can be leveraged during international cross-licensing disputes. While this created some temporary cautiousness among conservative legal analysts, it has done little to slow down the massive commercial demand for their primary physical networking hardware. When you look back at past performance, the historical baggage becomes very clear. This is an iconic institution that once controlled over 40% of the global mobile phone market during the late 90s and early 2000s. After failing to adapt to the smartphone transition, the company famously sold its entire mobile handset division to Microsoft in 2014 for over $7 billion. From that moment on, management completely rebuilt the corporation from scratch, focusing entirely on buying up industrial telecom rivals like Alcatel-Lucent to become a pure-play infrastructure provider. For nearly a decade, this turnaround strategy yielded very little capital appreciation for retail investors using traditional investing sites or self-investing portfolios. The stock spent years stuck in a tight, depressing trading range, heavily weighed down by intense competition from low-cost Asian suppliers and the cyclical nature of carrier spending. Many individual brokerage accounts held the stock as a low-cost dividend play, but few expected it to ever see explosive growth again. This brings us right back to the central tension between past expectation and current reality. The market narrative has spent 10 years treating this business like an obsolete hardware vendor, but the modern financial data proves they are turning into an essential cloud connectivity powerhouse. The primary challenge facing investors right now is a major valuation puzzle. Even though their specialized data center and cloud segment is experiencing hypergrowth, it still only represents roughly 8% of the company's total aggregate revenue. The massive mobile networks division still commands over half of total group sales. This creates a fascinating divergence on Wall Street. Conservative research analysts are hesitant to apply a high-growth software multiple to the entire corporation when the majority of its revenue is still tied to slow-moving telecom hardware. Less than half of the institutional analysts covering the stock currently rated as a buy, and the average Wall Street price target is actually 25% below where the stock closed on Friday. This massive disagreement between conservative analyst targets and explosive market price action is exactly where astute investors can find significant opportunity. The market is pricing in a future where the high-margin cloud infrastructure business rapidly scales up to become the dominant revenue driver of the entire corporation, effectively leaving the low-margin mobile business behind. If that reality plays out over the next 12 to 24 months, the current stock price will look incredibly cheap, even after the massive 140% rally this year. However, if global data center spending slows down, or if the legacy mobile division suffers further contract losses in major North American markets, the stock could face a sharp downward correction as its valuation multiple contracts back to historical norms. Looking forward into the second half of the year and beyond, there are several distinct catalysts and risk factors that will determine whether reality can continue to outpace market expectations. The most critical catalyst to watch is the upcoming layout of their newly established research facilities.
If the company can successfully leverage its deep engineering partnerships with key chip developers to secure massive multi-year infrastructure contracts with major sovereign cloud systems and global tech enterprise networks, it will prove that their addressable market is expanding far beyond traditional telecom carriers. Investors using advanced online investment platforms and monitoring real-time order flows should watch the book-to-bill ratio inside the network infrastructure division very closely. Any sustained figure above 1.15 will signal that the high-margin revenue pipeline is accelerating, which would force skeptical Wall Street analysts to aggressively upgrade their consensus price targets. Conversely, the primary downside risk remains execution speed and macroeconomic capital constraints. If inflation pressures persist or if global enterprise budgets tighten, data center operators might delay their hardware upgrade cycles. Furthermore, because the business operates globally but reports its core financials in euros, it remains highly sensitive to volatile foreign exchange fluctuations, particularly between the US dollar and the euro. There is also the constant threat of intense margin competition from alternative hardware providers who are rushing to develop competing optical transport systems. If the company is forced to cut prices to protect its market share in the cloud space, its gross margin expansion could stall out, destroying the current bullish thesis. Ultimately,